Hello. So I just wanted to show you here why is it that we always say that the stock market goes up 9% on average. So I pulled up here the S&P 500 index. So this is the largest American index and also the largest index in the world. So it shows the top 500 American companies like Apple and Microsoft, so on, into one single graph, one single index. So today's price is 4,308. And this index goes all the way back. So if we change it to a monthly view here, we go all the way back to 1800, 1871. And if we put in the price here at 4.5, so 4.5 US dollars for the index. So we put in this into the calculator. So we say 4.5, and then it's from 1871 to 2023, so that's 152 years. And then from all the way till today, let's take it at the end of May. So we have the price in end May in 23, that's here. That's 4,178. 4,178. Here's this kroner, that doesn't matter, it's the same. We can see here that the return is 4.6%, and this is without dividends. So this is just the actual return of the stock market. So 4.6 in return on average over the 152 years. We want the dividends because companies pay out dividends to the investors as well. So I found another calculator. So let's say again, February from 1871 to May 2023. And we click calculate. And we can see that again, we get this 4.6 return every year. And then if we take in S&P 500 return with the dividends reinvested, we get this 9% return per year. So that's where we got the number from, 9% per year. And then sometimes you read 7, and that's because of inflation. So if we click here, adjust for inflation, and click calculate, we get this 6.97% in return. So those are the returns that you can usually expect when you invest in the broad stock market, and the numbers usually come from the S&P 500 index. So what does this mean? Well, if you are to invest, let's say, so these are my own calculators, let's say you invest 25,000 US dollars initially, and then you put 500 into the stock market every month. So 500 here. We take the return you can see in the account. So without inflation, that's 9%. And over 20 years, you then get 475,000 US dollars after 20 years. The graph is here, looks like this. And if we take the inflation, so the 7%, the return is then 360,000, your real return, as it's called. So that's it. That's why we use 9% and 7% in your return. Cheers.